Welcome back to FANG Friday. I'm Ross Healy, Chairman of Strategic Analysis Corporation, bringing you this week's update of what's happening fundamentally and technically with the FANG stocks. So let's get started. Last week, I offered viewers one reasonable buy recommendation. I observed with the new balance sheet in our database, NVIDIA was clearly breaking out over its HB1 price, or 10 times its adjusted book value. The earnings and the fair market value line were turning back upwards, and a continuation of the rally that had started at its bubble price, or 8 times adjusted book, was in order. I observed that the stock was probably heading for its HB2 price, or 12 times its adjusted book value. That's about $200. It has continued on that trend this past week. Let's look at Facebook. I had pointed out that Facebook had already reached our upside target, its mid-super growth price, or 5.5 times book value, and was having difficulty going any higher. I will stay with that assessment as the company runs into one regulatory cement mixer after another, unless or until the stock can break out over that MSG price. Personally, I doubt it, but I don't try and second guess my charts. Amazon, when it was falling, actually tried to move down another breakpoint than its HB3 price, or 16 times its adjusted book value, but the market rally actually pulled it back on side where we had ranked it as a hold. It's consolidated for 2 months now before hopefully moving on, perhaps to the HB4 or 20 times adjusted book. Note that in any market correction going forward, that HB3 level must hold. In the longer run, I think that this stock is not finished on the downside by half. Netflix met its upside recovery target, its HB5 price, or 25 times adjusted book value. And this has been a stubborn technical resistance to any further upside for the past 2 months. Personally, given its extreme downside risk based on its fair market value measure, I would not be holding this stock now unless it can break out from here. And even then, it would be on a purely speculative basis alone. Now, looking at Alphabet, I hope that you can see the issue with this stock at one glance. It has been trading largely within a fairly tight channel compared to most of the FANGs for the past 10 years. It's been bounded by its mid-growth price and its low super growth price, which is to say 2.5 and 4.5 times book respectively. You can see that the corrections to this stock price during that period have been to a great extent almost sideways in nature, unless you have been a very nimble trader. This is the cheapest of the FANG stocks in price-to-book terms, and it is the second cheapest in price-earnings ratio terms. Trying to trade this stock is inherently futile as far as I can see, and I would simply, happily hold these shares. Finally, reading Apple is an interesting exercise. I keep coming back to this 10-year chart, which shows the resistance being put up by the mid-super growth price, that is to say 5.5 times adjusted book, for all but the past 12 months, when it broke out due to share buybacks. In other words, technical, or as we call it, structural support actually fell away underneath the stock, leaving the shares in new high valuation grounds in price-to-book terms. Up here, the price is a sort of what I would call an accidental tourist in a strange land, given its indifferent fair market value potential, the dashed line, which actually you can see is starting to fall, we thought that it was likely, not guaranteed, but likely, that the shares would return to where they had been in the past decade. And they did. They fell to its MSG price, 5.5 times book, once again. Since that time, they've enjoyed a reasonable rebound from there. But the last time that I spoke to you, I said that I thought that the fair market value measure, the dashed line, would be a reasonable and probably maximum recovery target. And so far, this has proven to be the case. As a reminder to anyone new who just tuned in today, each week we use structural valuation analysis, a unique methodology which visually combines fundamental with technical analysis to show you where the FANGs are, how they got there, and what the charts are telling us is likely to happen going forward. If you are interested in learning more, go to our website, strategicanalysis.ca, for further information. This has been Ross Healy, Chairman of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you have the right tools. See you next time.